And Chair Powell blamed pandemic-related bottlenecks and other supply constraints for creating what he described as a, quote, perfect storm of high demand and low supply, but said that should partially reverse as the effects of the bottlenecks unwind. And the question, of course, is will they? But a different view from the latest New York Fed survey to tell you about inflation expectations continuing to rise, hitting a new high. So joining us right now, talk about whether the government is overstimulating the economy. Wendy Edelberg is here. She's a senior fellow at the Economic Studies at Brookings Institution and the director of the Hamilton Project. And Joe Livornia, he's the former chief economist for the National Economic Council and currently serves as chief economist for the Americas for Natixis. Why do I never pronounce that right, Joe, and I apologize. Wendy, take this on. Who's right? You're looking at the survey. You're looking at what Jay Powell has to say about this.
I think that the inflation expectations that Jay Powell probably more has his eye on are long-term inflation expectations. So for sure, short-term inflation expectations have come up. It would be absurd if they haven't, given the inflationary pressures that we've seen. But what's key is whether or not that translates into longer-term expectations. And there we have seen that market participants are seeing through these temporary surges in prices. Inflation expectations, let's say 5 years from now, look to be just about where they were over the past decade before the pandemic. And in fact, they've come down since May. So I think that gives Jay Powell a lot of room to move.
Joe, transitory or not? It's almost like a cliche at this point to even ask the question.
Right. It's transitory. This is a post-pandemic related price level adjustment. It reflects the fact that when I was at the White House, we were talking about a V-shaped recovery. That's continued, obviously, into 2021. There's still a lot of very good momentum the economy has, and demand has just moved faster than supply. Eventually, more production will come online, and those price pressures and bottlenecks will dissipate. Where you are seeing a lot of inflation, Andrew, though, is in asset markets. And if you look at surveys of what equities and real estate are likely to do, you do see a lot of inflation. So my sense is as we move forward, we'll see the traditional inflation metrics moderate, but asset price inflation will persist.
Joe, I was talking to a hedge fund manager last week who we somehow got into a whole conversation about how you can't buy furniture or you can't get a couch. If you order a couch today, your couch is not going to arrive till November or December. And we were discussing the idea that, right now down in North Carolina and South Carolina, every furniture maker is hiring as many people as they can to try to deal with this bottleneck. And the question, though, is, come December, effectively, will everybody who needed a couch get their couch? And then all of those people who were given jobs to try to deal with the bottleneck, will they not effectively have jobs? Or will the people who now have jobs all of a sudden need to buy their own couch?
On the goods side, if you look at the data, goods, the share of goods within GDP or consumption was generally rising at a nice 4% type of trend line prior to the pandemic. And of course, the economy shut when it reopened, Andrew. The demand for goods just surged, and that was a lot of pent-up demand. And we're about 4 full percentage points above the long-term trend line. So what happens in December is not only do the people get their furniture, but you're probably actually going to go below trend because production will have increased enough to meet demand. It's what we're seeing, for example, you look at lumber prices. Lumber prices were exploding to the upside. Housing is booming. Production's increased because COVID-related restrictions have dissipated, and now you can meet the demand with existing supply. The issue with the labor market's more interesting because you have a lot of job openings. It's still relatively high unemployment rate. I'm not sure that's going to be resolved. The bigger issue is what happens on services and how much of that pent-up demand is met, and whether the economy can fully reopen in the fall, and there's not issues with variants and things of that sort.
Hey, Joe. So Andrew kept saying Joe, and so he kept shocking me into listening. So I've been paying close attention to everything because Andrew kept saying Joe. But I was thinking about this morning, Livornia. I mean, this $4 trillion. If you add the $600 billion in for the infrastructure, and then they add the $3.5 trillion on top of that they're proposing, and it looks like they might be able to do it. So that's $4 trillion, and I can see how that has people thinking about inflation, but it's not even done yet. None of this has been spent yet. So everything that we're seeing right now is probably bottlenecks, and it's probably reopening, and it can all be explained by that, not what's going on in D.C. But is it possible that there's like pre-jitters, that the markets actually build in some inflationary fears based on what it looks like these people are doing in Washington? Or is it too early to see the actual inflationary effects of that?
These hedge fund guys have wanted to be short the market for a while, and we're talking 2% plus 10-year notes. And we had a big squeeze last week, finally capitulation, and yields fell as I thought they would. If we get $4.1 trillion, which is the 3.5 budget agreement we had the other day, plus the roughly $600 billion that was agreed to on the bipartisan commission, Joe, we will take a transitory inflation problem and likely make it permanent. I don't think investors are focused yet on D.C. We're not going to know exactly the details of what this recent rough agreement will be and what those details will look like until probably September. But we will have an inflation problem if we spend $4 trillion more dollars.
Yeah, but so on this point, I got to say, I totally disagree, if I can jump in. So the transitory inflation pressures that we're seeing now are because we're expecting a surge in economic activity that's not going to last very long. It's going to last several quarters. What's on the table in terms of perhaps as much as $4 trillion in expanded government activity and infrastructure in the social insurance system, those are longer term changes that they're not going to result in massive increases in economic activity over the course of 2022 and even perhaps 2023. The economy will have probably fully adjusted to the roller coaster ride that it's currently on before any of the significant economic effects of the packages that are being discussed really come into play.
Shepard Smith here. Thanks for watching CNBC on YouTube.